Hello, everyone. Welcome to the Papers Industry Digest. My name is Vlad Macovei, Senior Editor, and today I'm joined by Bob Lyddon, an expert in international banking and payments with decades of experience. Bob is known for his sharp insights on financial infrastructure, and today he'll be sharing his candid views on the current state of open banking in the UK, what's working, what's not, and where it's headed next. In this conversation, we'll dive deep into the realities behind open banking's promises, its impact on competition, and whether it's truly delivering value for consumers and businesses alike. With recent industry shakeups such as Vine exiting the UK market, there's no better time to assess the future of open banking and what it means for the financial ecosystem. Hello, Bob, and thank you for
Oh,
taking the time.
well, thank you, Vlad. Thanks for the invitation. Great.
Let's start with the first question, and that would be, how do you assess the current state of open banking in the UK and what are its primary challenges?
Yes, I think it makes a great PR noise, but I don't believe that's matched by usage, regular usage by customers and regular benefits. I think the numbers are skewed, starting to be skewed by users like HM Revenue and Customs. If people use an open banking solution to make tax payments twice a year, okay, there could be 6 million entities doing that, right? So a person who is multiple sole traders could represent 4 people. They're doing something twice a year. Suddenly that's 8 million users. So I think there's a big skewing of the statistics of success that open banking claim and the real impact it's made, which as far as I'm concerned, is minimal. And the impact has been in areas that it was not established to do. It was meant to move the deposit bases and current account balance bases of the major banks and distribute them round perhaps 20 institutions rather than 5 or 6. That hasn't happened at all. Instead, yes, I can see that for certain sizes of business, it's very useful when they have multiple bank accounts to get all their statements in through one channel. Yes, and it's not new, but the open banking technique is definitely superior to what existed before. But that isn't new. You could do that before. But where there's something that wasn't done before, I just see far less impact. An impact in an area it wasn't set up to address, like credit scoring, keeping people from not gambling too much. I mean, these are peripheral compared to what it was supposed to achieve, but are now repositioned as the main things. Once that fails, we pull in something else to say, oh, it's brilliant, or always going to be brilliant. It's never necessarily brilliant today.
And looking behind, do you believe open banking has lived up to its original objectives?
Well, definitely not. No, they seem to be forgotten. It was to unravel starting off with the risks to deposits of people and businesses posed by the major banks in the financial crisis. In other words, the supposition that if you had an account balance at the former Royal Bank of Scotland, their dealing room was risking it on buying residential mortgage-backed securities. So the antidotes to that were firstly to split in UK banking in the big banks, the ring-fenced bank from the international investment banking, and then across the piece that open banking should unlock the deposit bases because there was a lock-in between how you access the bank account, getting at the bank account, who held the account, and making your payments. So in other words, the 5 or 6 big banks, they had all the deposits, they owned the payment systems, so they owned Bax, Faster Payments and Chaps. So they had a lock-in, and open banking was meant to pull that lock-in apart and make sure that the deposits were spread over 15, 20 institutions, including the newly set up ones like Starling and Monzo. And yet actually, A, that hasn't happened. B, I don't think the underlying analysis was sound, because actually, if you look at the names that fell during the global financial crisis, here, Northern Rock, Alliance and Leicester, Bradford and Bingley, these at Halifax, Bank of Scotland, these were purely domestic institutions not engaged in international and investment banking. But actually, the whole idea that customer deposits were at risk due to international investment banking was only true of RBS, not of all the rest. But that was a very unpopular, would have been a very unpopular diagnosis. And everybody prefers to blame international investment banking, to which problem open banking is an antidote. But if the underlying analysis was wrong, the antidote's wrong. And so it has proved.
Thank you, Bob. Is open banking a business model or a state-directed initiative? What prevents open banking providers from achieving sustainable profitability?
Well, I think one of the things is that payments as a business, apart from in cards, so card payments are very profitable. You get all these fees, they're incredibly difficult to unravel, understand how much is being paid and what it's costing you. And then you have payments, which is credit transfers and direct debits. They've become commoditized, they've become cheap. Well, they're free. So how can you make money out of a service that's free? Then you come back to the European Union model for the payments business, where you have these rails, the so-called rails, that are open to everybody, cheap, commoditized, free to use. And then the idea that you have value-added services traveling along those rails. Well, it looks great on a PowerPoint slide, but that hasn't really happened, because the payments, the commoditized payments, are the ones that go on commoditized rails, and you haven't got value-added services on top. So where was the profit? Where's the profit in that? And it is state directed, because the open banking was designed hand in hand with the EU Access to Accounts initiative, which was crystallized into the second EU Payment Services Directive. So this is, after e-money institutions and payment institutions, it's the third type of new payment service provider that the EU thought was needed to open up the market. Well, why are they so brilliant at everything? The fact that they said it would work doesn't mean it will work. And it hasn't worked there and it hasn't worked here. It's just another spin of the wheel of trying to create more competition, effectively competition against the card systems. Now, with account-to-account payments, maybe that will start to happen. Variable recurring payments. But again, that's not new. I mean, where I worked at Bank Boston, the long defunct Bank Boston in 1984, we could do variable recurring payments, no problem. We could already do that. All right, not with the nice technology and the nice user interface, but we could do it. Now we can't yet even do it on a multi-bank basis. So making payments from other banks through the Bank Boston client interface. We could do that in 1994. Not very smartly, but was doable. And yet here we are, 2025, and still thrashing around as to how to do something really basic and simple. And that with the state direction of the scope of open banking. The scope of open banking is the same as EU account to account. That state directive, why are they so brilliant about creating a business? And yet everybody's piled in. So yes, it's state directed, and the EU market model for payments has no money in it. In fact, the whole idea is that everything should be free. Where does that get you?
Yes. In April 2025, so soon enough, Vine will shut down its operations in the UK. Do you expect other open banking providers to follow suit?
Well, I think that must be a kind of last resort, isn't it, to shut down? It's very brave to shut down because you're saying effectively everything you told the people who put money into this, the angel investors or whoever, I'm sorry, we were wrong. There is no money in this. Um, the alternative would be, I mean, to take it back, what happens to the money that comes in when open banking says we're driving an economic growth? Well, fine, some provider raises a couple of million or more from a venture capitalist. The cash comes into a bank account. Here, it's spent. That adds to GDP. You get office space, you get desks, computers, you get computer software, and a lot of those assets are capitalized. So they're held on the balance sheet. This is worth £3 million because the accountant would insist that there was some realistic prospect of that investment recouping £3 million. And the following year, we spend another 3 million. And now the amount to be recouped is 6. So when do we start getting money in that justifies the valuation of these assets? That, okay, money is spent. The money that comes in is spent. That adds to GDP. But where's the payback? And Vine must have thought, well, we're not going to get a payback on this. What are our options? What do you do rather than shutting down? You consider merging with or buying another player to add to scale. But if you get into a business where the cost of processing each extra customer is greater than the revenue you get from that customer, you have negative economies of scale. The bigger you are, the more you lose. And to me, that's the characteristic of open banking, that if you have customers that cost more to service than they bring in revenue, the best place to be is to have no customers, to shut down. Because where is the break-even point then at which you have, how many customers at which do you start to break even? I don't see any discussion about what's the minimum scale you need to be running at in order to make money. I don't see any discussion of that in the industry because it could be 5 million users. It could be 500,000. Who knows? Well, the trouble is, it's not up to me to know, but the industry should know. And then you should see combinations going on of mergers, takeovers that result in them hitting that number of users that is needed to be sustainable. And I'm not seeing that at all. I'm seeing scope creep. Oh, we need this extra service, or we don't just need open banking, we need open data, and we need open finance. These are all, this scope creep is always an indicator that it isn't working as it is now. So there's not enough added value in the services. There aren't enough users. It's no one's making money. And then you need to break out either new services, are those even permitted? Because, these are regulated providers. You can't just start doing something that'll make money because you see potential. You have to think about relicensing as a bank or as an e-money provider. You can't just go for it. So you're hemmed in to the box that is an open banking provider. And what do? Try to exert pressure that you should be permitted to do open data, open finance, or you combine with another provider to give yourself economies of scale, which is no good if you're actually working in a negative economies of scale, or you shut up shop. Which is it? There seems to be no clear pattern in this marketplace. But Vine has put a marker down by saying, we're off. Cheerio.
Did open banking truly increase competition in the financial industry and disrupt incumbents? And what has been the impact on traditional banks, mainly in terms of competitivity?
Well, no, I don't think it has, because as I said earlier on, it was meant to result in 15 or 20 large banks with the total deposit base spread around them, not necessarily evenly, but there are bound to be bigger ones and smaller ones. But there should be 20 sizable banks, not still 5 or 6. So it hasn't done that. And the concept was that open banking should become something like, to the banking industry, Go Compare. So you look on there, you see the different banks offering a similar service, a service that's similar enough. You just click on that one and you buy it. And unfortunately, banking isn't that simple because, all right, we've got the current account switching service, but not many people only use the services within the scope of that switching. So there's loans, other parts of it. And so it's not, a banking relationship, even for a fairly simple retail customer, isn't the same as just this insurance policy, which has a scope around it, car insurance, house insurance. Nevertheless, the idea was you could go on a screen, here's the key terms and conditions of that current account or that one, and I just picked that one. And I don't think that seems to have emerged at all. I think actually it was impractical because the differences between the types of service. But I haven't seen that emerging, and I haven't seen the switching, not of numbers of customers. Okay, the current account switching service says, oh, this many have switched and that many have switched. But you'd need to see the amount of money that moved. You've got to be talking hundreds of billions of pounds of deposit balances need to have ostensibly, visibly moved between different providers to say that open banking has succeeded in eliminating this lock-in. And then what I think a lot of it comes down to scope, because if you go onto the Lloyds Bank customer internet banking, there's a lot of functions in there. There's a lot of things you can do in there, look at, use. It's much more than is permitted for open banking. So although the marker for open banking, or the service that a Lloyds has to provide over open banking, it has to be on a par, the same service level as it offers for that service through its proprietary interface. But the scope of open banking is much narrower. So it'd be wrong to think I can go onto open banking and I can get the same scope of services as I get by logging into 6 different banks or building societies individually. You'll get the same service level approximately for what you can do, but there's an awful lot you can't do. So the traditional banks will simply build out the offering, the online offering, outside the scope of open banking, and just make sure that within the scope of open banking, what they offer is on the level. And actually what that means is they've strengthened their own proposition, and strengthening their own proposition makes customers stay. They're able to respond. So again, to me, apart from a few like Starling and Monzo who've come out with a direct proposition for their customer interface, so that's not an open banking proposition. Starling, Monzo have their own channels. They've gone into direct competition with the incumbents and been quite successful, but that's nothing to do with open banking. All right, they might use some of the same tools and techniques, but actually it's a direct proposition to customers, and then they've got some traction. But otherwise, I think it's had very little impact. But in the realm of government and public affairs, it's had a tremendous impact. It's the number one thing. You have this discrepancy. Out in the real world, it's insignificant. In Westminster, the FCA, the Payment Service Regulator, Pay UK, oh, it's really big. Any payments conference, oh, open banking, really big. But real world, it's not big at all, is the impression I get.
Thank you, Bob.
We notice a global debate on open banking being considered either market-driven or regulatory-driven. Was it driven by customer demand, or should it be considered a strict regulatory initiative?
Well, it's regulatory because the global financial crisis was diagnosed by many of the same people who caused it.
Hmm.
Now, what do? They divert attention. They say, oh, no, it was their fault. Oh, no, their fault. No, never my fault. So they say, oh, dear, it was excessive risk-taking, mainly by foreign institutions. Just like apparently Rachel Reeves is saying today, the UK economy has been hit by international forces. Much more convenient than saying, no, it's our problem created right here. So we have distraction when it was invented. We have regulators or bodies. I mean, the bodies that formulated this opinion that open banking was an antidote, and many of them weren't bankers. They certainly weren't payment bankers. Many of them had no financial experience at all, but they were, lords, baronesses, this level of person who dictates so much of what goes on. They were incorrect. Open banking was never the thing that was going to solve the crisis as it actually occurred. But then that gets translated. It merges together. We had the UK changing banking for good. What's it? The Vickers report. At the same time as you had EU open access to accounts, it all merged into this open banking is the way forward. But it's all driven from regulators. And, I certainly never received a questionnaire to ask me whether I thought this was a good idea and whether I'd use it. So it's completely top-down driven. But because it had that degree of regulator support and it had EU support, the business case, we're opening up the market, new type of provider, please pile in, it attracts a lot of players. But where's the customer? Was the customer ever asked? Was the demand for exactly that service provided in that way really proven? And the answer is no, it wasn't. And that's why then the open banking goes around fishing for things to hang its hat on. Financial inclusion, that's another good one. Mortgage scoring, credit scoring, helping people not gambling too much. But these are secondary and they've been brought in when the first one didn't work. So regulator driven all the way. And some customers will naturally pile in, but you hear all of customers, well, mainly it's debt charities who say open banking, if you get the mobile phone or the tablet of somebody who's deeply in debt, you'll find 7 or 8 open banking provider apps on there, all linked to the same accounts. So maybe this person's got 15 or 20 accounts and they've got them linked to their phone through 9 different open banking providers. Do they ever use those apps? No, because the amount of money they owe doesn't diminish just because you look at it through yet another app. They owe loads of money. They're in overdraft, debt problems. But if you think of statistically how that would impact, that's 90 users, 10 accounts, each being reported through 9 different providers. That would rank in open banking statistics as 90 users. And to me, that's the kind of discrepancy where the statistics and the actual market, the actual degree of usage diverge tremendously. So on that basis, if open banking said it had 9 million users, actually it's got 90,000 because each user is 100 accounts. Each one individual actually translates into 100 users in the ways the statistics are collected. That's the kind of discrepancy I think we're dealing with here.
Thank you, Bob. How did open banking services manage to improve customer experience if they did so?
Well, I think in certain cases, of course, for certain people who look at their bank accounts all the time. I mean, I don't look at my bank accounts 24/7. I don't want them on my phone because, I don't want, I'm not deeply in debt, but I just can't be bothered with that. That's not my center of attention the whole time. Maybe for some people it is. I think for certain types, particularly small businesses who would find the collection of accounting data, statement data of multiple banks very clunky, because in the techniques that existed in the 60s, 70s, 80s, 90s, using Swift, it's expensive and clunky to get all your statements through a single interface. Open banking's much better. Definitely there, but that's a streamlining of an existing process. That's not a new thing. Now, seeing all your accounts in one place as EU accounts to account to account, EU access to accounts was envisaged, is merely what they'd had in Belgium under a name called Isabel for many, many years. Or in Germany, was called multicash. You could get any German bank to report balances into the multicash and any Belgian bank into Isabel. But the EU wanted a single solutions that were available in multiple member states at the same time, not local solutions. So in that respect, it's similar to single payments area. It's moving from, albeit efficient and cheap payment means, but only applicable in one member state, to having efficient and cheap products that are available in all member states in the same way. So that was the EU objective, and it fits very much into SEPA, Single Euro Payments Area. Yes, that's great. But if you're a person, as most people are, who only operate in one member state and only have bank accounts in one member state, that doesn't really matter, does it? And in fact, the risk is that the pan-European offering is less functionally rich than the single country offering that you're using now, which has existed for many years. And that was a single euro payments area problem. Again, looked at here, who's benefited? Okay, a person with lots and lots of accounts. Who's that? How many people do you know with 30 bank accounts or something? Or 20 credit? Well, we know people with 20 credit cards. They're people heavily in debt. Is this what it's all about? Is this actually for people that are heavily in debt? But if they're heavily in debt, are they financially excluded? If they are, where is the market then? Who is this for? I don't know. I don't know actually, beyond the automation of statements, of statementing and cash application for small businesses, I don't know who's really benefiting from this. And that's the problem, that the demand for this was not firmly enough established at the beginning.
Okay. What is your perspective on the regulation shaping open banking? Is it beneficial or more detrimental?
Well, it's its lifeblood. It's the only reason it exists, isn't it? Without the regulation, this would not be permitted. The whole thing would not exist. So it's the double-edged sword. It permits it, but only within certain limits. And as I said before, that's where the incumbents have built around open banking. They've concentrated their developments in their customer interface and their general products in those things that are not within the scope of open banking. Because within the scope of open banking, you have to share it with others. Then you lose your competitive advantage. So they're bound to concentrate their investment in those things that are not shared, that are proprietary to them, that give them a competitive advantage, which of course are still permitted. So I don't see the way forward for open banking as being oh, they've got to be permitted to do this, or they've got to be permitted to do that. Scope creep. That's your business. If you can't make it work, you shouldn't have got into it in the first place. Get out of it, or merge, or do whatever it is. But don't keep thinking, oh, we can convince the government or the FCA to change the rules like this. Then that'll get us forward. And finally, at some point, we'll reach El Dorado. The thing is, El Dorado is a myth, is mythical. And I think you've got to look at where you are now. Is it working? And sort it within the current scope, or stop. I think actually the regulatory issue that's been perhaps the most damaging or difficult is this reimbursement for fraud. But then the industry as a whole has made the problem for itself. Faster payments is defective. The beneficiary name should be checked by the beneficiary institution on every payment. And yet that's like the one thing we never discuss in the industry. Why not? With a check, maybe a check, the old paper check, maybe the bank didn't check off the name of the beneficiary, or the payer and the payee, who's on the line in there. But if they didn't check in, they got it wrong. It's the bank's fault. They have to reimburse. However, with faster payments, if the bank gets it wrong, it's the customer's fault. That was a massive legal change that got slipped in by faster payments effectively replacing checks. And now you have push payment fraud. That could have been predicted. Change could have been introduced before that happened. But oh no, we just pile in, switch to faster payments, which is more risky for the customer. You get payment fraud, then we get confirmation of payee, then we get the this, that and the other. And at the end of it, we're no further forward, are we? And now, according to the latest rules, the open banking provider, if they are the conduit through which the fraudulent payment order was made, they have to eat half the loss. And of course, half the loss for them, given their low capitalization, could be very damaging. The industry has made this problem for itself over a period of a decade. I can't really offer anything more than faster payments should have been redesigned years ago, including a check on the beneficiary name on every single payment as part of the core process, and not kind of, oh, we'll do confirmation of payee around the outside, but the core goes through as it is. No. If you're going to have a mainstream offering like faster payment, which is the anchor, the middle of payments for small businesses and personal customers, you've got to check the name. And now we're, going off on another tangent on that thing.
The UK is seen as the open banking's main stage. How does the future of open banking in the UK look like to you?
Well, this is another thing, isn't it? I mean, faster payments has been exported worldwide, and now they're getting payment fraud. So why do we think just because we go first, our stuff's better? Actually, we don't have first mover advantage. We have first mover disadvantage. We seem to create things here that are detrimental to ourselves and others. Then we get a whole head of steam up. Imagine this has export potential, and then go and foist it off on all these other unfortunates that happen to listen to us. Yes, maybe it is exportable worldwide, but that's exporting detriment, not exporting benefit. I think we should be a lot more careful in recommending things to others that are not necessarily working here. Or maybe it looks as if it's working within our own little bubble, but actually when you look outside the bubble, it isn't working. The faster payments model is effectively been copied by the single euro payments area instant. They're now introducing obligatory reachability for SEPA Inst and verification of payee. which differs only from confirmation of payee by what, the first 6 letters of the name, it's the same. They're now worried that verification of payee won't actually eliminate the problem. They're quite right, because confirmation of payee was cracked up by its proponents. This will solve authorized payment fraud. And now, of course, when it didn't, the version is changed. The word, oh, we thought it would make a contribution, an essential platform for combating. No, you said it would solve it completely. Now you change your tune when it hasn't. And that, you see, the export of confirmation of payee to the EU will be the same. They haven't got a reimbursement scheme, but I believe they'll have to have one. They'll go through the same cycle, just like, everywhere else they took on faster payments. You've got push payment fraud now. So this is a pretty serious detrimental export business that we've developed. And open banking, yes, we're ahead. Are we ahead or are we behind? We've gone first, but I can't see the benefits. And it's not the benefits in open banking. What are all the other things we could have done as a payments industry? What are the areas that could have been invested in? Perhaps other ways of achieving the same thing, but many other things we could have done. But no, for a decade, open banking has hogged the center of the stage. It's the middle thing, the main thing going on. And therefore, it eliminates the possibility of, say, private initiatives in the same thing. If you came along and said, oh, I'm going to set up something called access banking, but we're going to use JavaScript, I don't know what we're going to use, Java Beans, whatever the heck it is, very easy, very quick, you'd be told, no, you can't do that because we're too busy with open banking. Open banking, that's what that does. So any private initiative that might try to do something a little different, but which overlaps, is scotched. No can do. Because instead you have this big project that says, oh, if you do this, you'll be able to do that with 100 banks or 200 banks. Whereas with this initiative, you might only be able to do it with 6 or 7. So that always gets the investment. Whereas this might have been a really good service of real benefit to hundreds of thousands of people, but it never gets off the ground. It isn't even discussed. And actually, that's what's happened. State-directed initiatives, because they always claim to cover the whole marketplace, all players, they squeeze out private initiatives in the same space, and even in spaces quite close by. So they actually end up hogging the whole thing, all the budgets, all the attention, all the regulator time. So do you think the FCA would have listened to somebody as saying, I want to set up access banking? And they said, well, you can't do that. You've got to do open banking. So where's free market then? Where's competition? You can buy any car you like as long as it's a Trabant or a Lada and that colour. And that's what's happened. It's become the kind of occupying the space, which precludes other initiatives of whatever type. And I think it's really been, in some ways, very detrimental by hogging the limelight without delivering.
This question, I think it will be the final one for our interview, Bob. You mentioned investments. What would be your advice to investors looking to enter the open banking space today?
Yeah, I'd say you need to forget what anybody puts in a PowerPoint. What is the break-even point? Where are the revenues? Are they real? When are they going to come through? What's the revenue per customer? Why is that robust? How do you get that revenue? Do you have to break the law to get the revenue, say by selling customer data that you shouldn't do? You need to be very careful. I'm not sure people are sufficiently careful. What's the revenue potential per customer. Therefore, how many customers do you need to reach break even? And if need to make sure that your pathway, don't part with too much money each time to make sure that you're on the right track. So don't give anybody a year's worth of money and then come back a year later, find they've spent the money and they're not on track. It's 3 months. Okay, for the company itself, that's a lot of effort to show that they're doing the right things every 3 months. Here's the pathway. Here's the pathway. We're on it or we're above it. If you're below it, cut it. Because the minute you go below, you're not going to get kind of like that and then suddenly go up like that. Because the proof is it's not working. You can't have one, here's the PR or the request for money, and then there's reality down there somewhere. No, you've got to do that or better. So it has to be, come on, show us the results finally. For somebody entering, it's actually easier if you haven't got in yet. But if you're in, it's you get into the sunk cost delusion. Oh, we've spent this much money already, so we've got to put more in. No, you don't have to put any more money in. When you sink money into something, it's sunk. Don't imagine that just by putting more money in after this failed, that suddenly things are going to go like that. It's much easier when you haven't got in yet and you see how things have shaken down. Say, do I want to get into this because there's money in it? Or no, I don't because there isn't, than somebody who's halfway in. That's much more difficult and much more difficult to see at what point you start to make money.
Well, Bob, thank you for your time. Thank you for your great insights. I'm sure our viewership will greatly appreciate this video interview, and I will definitely reach out soon for a follow-up.
Well, please do, Vlad. Thank you. It's been a great pleasure. Bye-bye now.
Bye-bye.